Hello and welcome back to a new stock toolbox video. In this video you will learn how to create your own portfolio and ideally a dividend portfolio. This will be some sort of robo-advisor. And let's simulate some different portfolios. And as always, you fill out fields that are marked like this in slide yellow. And then you get all of these results and results that are marked like this on the left can be hidden. If you just invest for dividend, then you don't need those data sets. And if you hide all of these rows, then you end up with this part. And first is the dividend yield that your portfolio will have, then how much dividend you get after tax, and how much you want to invest. This cell assumes that you don't make any more payments into your portfolio per month in the future. And this would be your average price earnings ratio of the stocks that you own. Then your average payout ratio, which means how much of the earnings per share a company pays out as dividend. Then your average market capitalization. And if you value each part equally, then each part should be worth around this much. And this one is, if you change this, ideally we start with allowing fractional shares, and later on we can swap to not allowing it to see what happens then. Here are some stocks that are from the Dividend Aristocrats, which are some stocks that paid a dividend for over 25 years continuously, and they even increased it annually. And this is the weighting, how important the stock is for you, as you can see here. If you don't want a stock, you put a 0 in there, and you don't take those stocks, you take your own stocks that you want to analyze. And if a stock is super important to you, then you make it a 3, and then it adapts and it has 3 times the rating of the usual other ones. Then you can change the price. This current price is the one that was exactly 1 year ago. And then you take the date that you want to buy it, or did buy it, or whatever. And this one is also exactly dated 1 year ago. Then you get the shares, given your rating that you will buy. Because it has 0 rating, it's also 0 shares. Then how you split it. Then you have the dividend yield of the different stocks. And the payout ratio. If the payout ratio is above 100, it means the company needs to take up debt to pay out dividends. And if it's 0, they don't pay out any dividend currently, apparently. And the higher it is, the worse it is. And if you want dividend stocks that are sustainable, then you shouldn't invest into stocks that have a payout ratio above 65 or maybe 75. So ideally you invest into dividend stocks that pay out between 1% and 75%. Then you have payout ratio. I did read in some books that it should be ideally between 12 and 40. But I think the lower the better. But if it's too low, there's maybe a problem with the stock, and then they might stop paying out dividends altogether. If you invest some money into this part, you say you invest like another 100 per month, then you see the monthly new buy adapts, and you buy like 0.05 shares per month, and daily that would be like 0.0017 shares. And this part we can later see how much months it takes until we get a new full share if we don't allow fractional shares. And here's the end value after we invested. And this is the stock that was weighted 3 times, so it's 3 times over the average. And after the period, I'm not sure about this formula, if that's correct. And then we get assumptions of the profit and loss and the weighted payout ratio, given how much initial investing you did in the different stocks. And what's the current payout ratio? If you watched my previous video, you know this one already. The time you own the stocks, 365 in this formula. Then you simply return, time-based return, then return on investment, then the weighted PA ratio target balance. And most of this is the same as in the previous video. If you want dividend stocks that pay out continuously and on time, you maybe want to disregard ones that are in the red in there. And if there's a num, that means that the next dividend date is already announced, and therefore the number in the future is higher than the current day, and then there's a num error. The blue cells are safety measures. You can just copy and paste them and put them down in there again, and then you have the same value and you can drag it down. And about the fractional shares, if you don't allow fractional shares, you either have to reduce the amount of stocks that you buy, or you increase the amount of money you want to invest, because if your total investment is lower than the lowest share amount, then you can't buy any stocks. And then you probably should buy like one stock at a time and not multiple at once. Then you can see how long it will take until you can buy another stock. And there you can buy a new stock after half a month. And some other stocks take you like 13 months until you have enough money saved to invest into a complete share. Something else that you might need to change, I adapted the graph. So it also regards the exchange rate now, if it's in euro, for example. And you get a new graph about the profit and about dividend received so far. I edited the continuous reinvestment. If we go back to allowing shares to be fractional, and we invest like 1k a month, and if we unhide all of these ones again, then we will see our performance if we do some monthly investing, and the performance would be a little bit worse, and took averages and made the formula way easier, so it's not that accurate, but approximately should be alright. That's our portfolio value, and this is how much we paid for the stock. If we go back to no, then we see what else changes. And I used the exchange rate of US dollar to euro again to see how my investment would fare with no reinvestment. And that's the euro value compared to the dollar. Everything else was pretty much the same. And I made some errors about smaller cap stocks. They are better for performance-wise usually. But 3 of my stocks that I own filed for bankruptcy, and that's not very pleasant. So I thought about going upwards in the market capitalization to stocks that are more value-based and a larger cap. So I'm going the path of Warren Buffett, and I started out with cigar butts and now see myself on the doorsteps of going into value investing and blue chips. This will be the cut down version, where I trimmed all of the stuff that isn't as important. And I also added some new formulas for dividend yield with a compounded annual growth rate of the last 3 years, and the same thing for the 5 years. Then I took the 3-to-5 ratio, when the last 3 years grew faster than the last 5 years, the dividend. Then we have a value that's over 1. The projection over the next 10 years would be these values, given the 3 years and the 5-year compounded annual growth rate. And if you look at the top rows, then you see some of the formulas are hidden, and you can look at them if you're interested in formulas, but for your convenience, they're just hidden right now. And that is the slim version in quick. It looks like this. And the extended version is the same, just with all the hidden tabs shown, as well as the new change with the 3 and 5 year dividend growth rate and the extrapolation. And about the rule sets for dividends, I don't have that many yet. It's just a low payout ratio, ideally under 75%, then dividend yield, a starting yield between 3 and 6%. A stock with a really high starting yield might be not sustainable, and you want a PE ratio between 10 and 40, somewhere in there, because if it's too low, the company might be in a bad situation, and if it's too high, it would take a long time for you to double your money with a high PE ratio, because it means the price to earnings. And if it's like 100, it takes you 100 years of earnings to get the price you paid back. I have the 3 to 5 ratio in the sheet, and the 5 to 10 ratio and others are in this sheet, and you can just copy those references over to the main sheet, and then you see them too. Dividend compounded annual growth rate. You have two options. If the starting yield is really low, then you ideally want a higher compounded annual growth rate. But if the starting yield is already pretty high, then you can live with a smaller one. Most of the books that I read for investing are from a website archive.org, and I can read them there for free. And if you want to support me and the author of the books, I made a list of all the books that were relevant for this video and for prior videos. You can click the affiliate link, and then I get a small commission from the seller if you want to support me that way. And if you like this content, then please subscribe. And for the future, there will be some new tools. This will be just a short showcase over the momentum and relative strength index. I just put stocks in there, and then it shows me the different moving averages and in comparison to current price to those averages. I'm not sure about the rule set yet, but this will be one of the next tools that I will make public. And another thing I thought about is a public list, where you list all of the stocks that you want to have analyzed, and I will look over them and will say like, this one looks interesting or this one doesn't look interesting to me, if you want my ideas to your stocks. And it's mainly for some friends of mine, because they always send me like names, and I have to look at the ticker symbol, and then I can research it and tell them, yeah, that one looks good, or no, this one has negative cash flow. And if you do it in this sheet, I can just copy paste this one and copy it into my formula, but I won't share my formula that I use to analyze the stocks, because that's my mode, and that's how I will make money in the future. And it's way superior to all of the tools that I will share here publicly, but I want to keep that one for myself. And thanks a lot for listening again, and I hope to see you soon. Bye bye.